Here's what the S&P did today. This is Thursday, February 23rd, and it looks like basically a game of ping pong where we reject off of this 400-ish spider level all the way down to 39.70 in the S&P. And what's funny is if we wind back to yesterday, as you can see in your chart, we basically did the same thing. We slid down to 39.70 and then we bounced higher. Then, as you can see here, after the FOMC minutes, we bounced down, then we gap higher, we bounce down. It's a game of ping pong. And so a lot of people go, hey, what is 0DT doing? Well, it's driving this game of ping pong. Now, before we get into our analysis that shows you this flow, we wanted to point out this article from, it's on Zero Hedge. It's basically the analysis from Bank of America, and they push back against this Volmageddon idea by Kolonovich. And essentially what Kolonovich said from JP Morgan was like, look, this imbalance in 0DT is going to cause Armageddon because everyone's going to be on the wrong side, and then eventually it's going to trigger like this flash crash. And one of the things I would state, first of all, is that if you actually look at what the S&P did on Volmageddon, it was about a 5% sell-off. So yeah, the VIX doubled on Volmageddon, but overall for the S&P, it was like a 5% move down, which we've already had a few of those. And we've pointed out that, hey, no, what's happening now is that it's not traders selling necessarily options. It's a big mix of flow. But where the 0DT seems to be getting the most use is long call buyers and long put buyers, not necessarily these guys selling, trying to rake in a bit of extra income. And so if you read this B of A article, it basically tells you the same thing. It says, look, it looks like what's actually happening is most traders are coming out and actually buying the 0DT options, not actually selling them. So you can see here, 75% of the trades occur near the bid or ask more than any other tenor. So essentially what this is getting at is early in the day, we're buying calls, we're buying puts, and then we're just monetizing those as they move. This is an important insight when we show our dashboard here. So if you look over at the SpotGamma dashboard, there's a bunch of lines on here, but we want to be very clear as to what these are. First in white is the price of the SPX, right? Again, there's this game of ping pong. This is yesterday from 6 a.m. until the close, and then again, we opened here 6 a.m. until the close, and you can see there's this very range-bound price action here. Now, in green is the 0DTE order flow combined for the SPX and the SPY. So we only are measuring the hedging impact from 0DTE in this case. And what you can see are very clear trends. For example, as the market opens near the high yesterday, all the 0DT flow comes in and the market drives lower. Then what happens? The 0DT flow that was sold, the negative deltas that came into the market were covered or traded. So where people were buying puts here, all of a sudden they close those puts and they buy calls here. And you can see it's a leading indicator of sorts. You can see the green line, which again is the options flow, is coming in before the market moves. We then have fairly sideways actions in the 0DTE, and we ultimately break down, right? So again, negative delta trades come in after the Fed minutes, which is right here. So this action just before this area is the Fed minutes. The Fed minutes come out at 2 o'clock, and even though the Fed minutes didn't say a whole lot, this negative delta flow came in, and then right at 39.80 in the SPX, all that flow is covered into the end of the day. Again, just like B of A said, we get long put buyers or long call buyers. In this case, it was long put buyers, and they cover into the close. They monetize their puts. So we fast forward through today, and the market was weak on the open, as you can see. And what happens here, which is quite interesting, is even though the market is weak throughout the morning at 39.80, the delta flow, the positive delta flow came into the market all day long. As you can see here, the S&P did break down earlier with the 0DT flow fairly quiet. And then again, exactly what happens is around 11 o'clock as the market is making its low, the 0DT flow is just surging higher, right? It's just breaking higher. And what that is it leads the market up. Now, what happens as the S&P hits the top of its range, again, up around this 40-15 area, which is coincidentally around 400 in the spiders, you can see that negative delta flow comes in two waves and the market stops rising. So essentially people who bought the bottom, right, with these calls, they sell the puts. Now, if you add in on top of this, you can look at the all delta flow, which is essentially showing you, so what we've done here now is flip from looking at just next expiration to all delta flow, that is all expirations flow. And you can see it's a very similar thing. In this case, though, there was even a stronger buy the dip response. You can see if you add in, all the other expirations outside of 0DT here, and then again into the close, you can see traders monetized or unwound those positions. So this is essentially the game of ping pong that's taking place a lot during the day. This was something last week or 2 weeks ago into OPEX where we're getting these big moves from 4150 down to 4100 and ping pong back and forth. This is the type of flow that seems to be hitting the market intraday. right? And it's not so much exacerbating volatility in terms of expanding volatility. It may actually be on net containing or collapsing volatility. So I hope you found this interesting. If you do want to try this out, if you do want to take a look at HIRO and our indicator, you can get a free 7-day trial. Just go over to spotgamma.com. And if you have any questions, please put them in the comment section below.